Stocks are breaking new highs, the economy is breaking down, and the two have never felt more disconnected. And I think it's something that most people can feel. Data suggests that everything is great. The S&P 500 has returned 12% over the last year, whereas in the economy, big developed countries have had growth lower than inflation. There are three main reasons the stock market is pumping when the economy isn't, and the last one is practically propping up the entire market by itself. So the first reason to consider is the distinction between the two. The stock market is somewhat a predictor of what people think are going to happen in the future, and not a reflection of what people are living through right now. And that's where this whole disconnect exists. Because for the everyday person, things look completely different. Costs are still rising, inflation was 3.6% in October, and economic growth has basically been flat, just 0.1% in the last 3 months. Sentiment is weak, disposable income is being squeezed, and people just aren't feeling close to a booming economy. But markets don't react to the present, they react to what investors think is coming up next. And right now, investors are already pricing in interest cuts months before they happen. Even if the economy looks fragile today, markets are buying into a future where borrowing is cheaper and the economy is picking up again. And the data the economy relies on is always months behind reality. We only get GDP numbers long after the fact that they've been in motion. Markets move instantly. So at any moment in time, the economy is describing the past, while the market is reacting to the future. On top of that, companies guide their earnings in a way that makes the future look better than the present. If big firms say that they're expecting market growth next quarter, markets latch onto that optimism straight away, even when today's economic conditions look weak. And a lot of market movement isn't even based on current numbers at all. It's based on narrative, really. The AI boom, the tech supercycle, future productivity gains, these are all stories as opposed to guarantees, but markets move on stories long before they move on actual improvement. You can see this clearly from valuations. It's not just Tesla who are trading at roughly 300 times their earnings, showing that investors are pricing in future expectations into the current price. Nvidia is trading at over 35 times earnings. Amazon, Meta, Microsoft, almost every major tech stock is priced on what investors think the next decade in the future is going to look like, rather than what they are currently achieving now. And finally, people feel economic pain much quicker than markets do. When groceries, fuel, rent, everything required to live your day-to-day life is more expensive, that hits the household immediately. Markets don't really react until earnings of the big companies miss or the guidance they've got weakens. So you end up with a situation where everyday life feels harder, but stocks keep rising because businesses haven't felt the impact yet. So weak sentiment doesn't automatically mean weak markets. People can be struggling while stocks climb because markets aren't trading at the present. They're trading the future that the investors are betting on. So the second major reason is there is still a ton of liquidity chasing returns. So while a lot of households are really feeling the squeeze, big institutions aren't in the same way. There's still an enormous amount of cash sitting in funds, banks, and corporate balance sheets. And that money's got to go somewhere. And honestly, the saying the rich get richer has never felt more accurate than it does right now. Because even though savings rate, bond, and money market funds are paying the highest returns that we've seen in years, investors are still chasing more. They're chasing higher profits, not safety. That's where the stock market comes in. When you've got billions to allocate, you don't put it in a 4% savings account. Put it into the assets that you think are going to perform best, even when the economy isn't. And this is where a real disconnect starts to show. We have to separate the money the average person has from the money that institutions have. The wealth divide plays a huge role here. Most people are cutting spending and dealing with rising costs, but big investors can still deploy capital aggressively. And the stock market is reflecting their behavior rather than what the average household is feeling every day. So it's a completely different world. The average person is feeling poorer, while the top end of the market is pushing stocks higher because they still have the liquidity to take risks. So the markets can rise even when the people don't feel it, because the people actually moving the market aren't the ones that are struggling. And finally, the biggest reason why we haven't seen a market crash yet is big tech is propping up the entire market by itself. And this is the biggest reason of them all. The rally that we're seeing right now isn't a broad, healthy market boom. It's a handful of tech giants dragging everything upward with them. You've probably heard of them as the Magnificent Seven. They currently make up around 36 or 37%, so it kind of just puts into perspective how massive these companies are. And all it takes is for these to outperform the rest of the market, kind of drag it up with them. So when you look at the past headlines, most sectors are either flat or falling. Retail is weak, transport is weak, real estate is struggling, consumer stocks are barely moving, but companies like Nvidia, Amazon, Microsoft, Meta, and Apple have become so massive that their stock prices alone can pull the entire index higher. That is pretty much exactly what's happening. So when people say the market is pumping, what they really mean is that these 7 companies are pumping. It's one of the narrowest rallies we've seen in years, and these are fragile by nature. Even if one of these big tech companies slip, whether it's missed earnings, a slowdown in the demand for AI, or something unforeseen that could come up within the market, the entire market is going to feel it instantly, just because of the weight that these companies hold within the market. And the truth is, the market isn't rising because stocks are strong. It's rising because tech is strong, and tech has become the market. And that's why the disconnect does feel so extreme. The average person that lived the same life as a $1 trillion tech company, they live in the real economy, the one dealing with rising costs, weak sentiment, and slower growth. So when big tech booms, the stock market looks healthy, even if everything underneath it is a completely different story. This isn't a wide market-based rally, it's a tech rally, wearing the mask of a market rally, and that's why it looks as though the market is soaring while the economy is currently falling, because the part that's actually doing the soaring is only one slice of the entire system.